Welcome to this first session of the course Managing Strategic Risk. In this session, we will talk first about the course outline and we will discuss the premises for studying and applying risk management in different ways in practice. Then we'll outline the different types of risk and consider the potential effects of a changing competitive landscape. Then we'll discuss the effects of dynamic adaptation that may enhance the ability to deal with emergent risks that occur around us. Now, the purpose of the course, of course, you have read the whole course outline where it's explained in detail, but the fact is that around us, many things are moving. Financial rates, foreign exchange rates, interest rates, commodity prices, etc., are very volatile. And of course, that will influence the way we account profitability in the organization. Other things might also affect the business, total demand, fiscal conditions in the economy, tax regimes, etc. So at another level, there are also economic conditions. Obviously, we can be affected by natural hazards. Things happen that might have a negative impact on our business due to events in nature. But it could also be new innovations that happen and thereby might outcompete our existing business activities. So there are a number of different factors that can affect the business and our ability to run the business effectively and be successful. And these risks, we would like in this course to discuss the types of risks, how we can deal with these risks in order to avoid the negative consequences and hopefully also use the underlying volatility to find positive solutions for the future. So there is a broad perspective here on what risks are, what are the exposures we are faced with in the organization, and different ways of responding to this. Part of this is trying to deal with, say, financial and economic risks that we can quantify and thereby possibly buy insurance, as you know. It could also be different ways of hedging by buying futures or forward contracts in markets where we have a history of price developments and where the markets are developed to do these things. Now, when you get towards the type of risks that relate to political issues or to new business contexts, innovation, etc., we probably need different means. So being innovative and responsive to the changes might be more the answer here. And we will try throughout this course to try to take a balanced view on these different types of approaches. But let's start off by illustrating this with a concrete company example. You have in your course pack the case KN Energy Inc., which goes back to, it's a real company, obviously, but it goes back to the late 1990s. And we're back in the Midwest of the US, Lakewood, Colorado, which is a suburb of Denver, where KN Energy had its headquarters, headed by the CEO, Larry Hall, and as CEO and chairman of the company, he was driving an extensive growth of this company in the energy industry. So the focus of the company was natural gas, getting access to natural gas from the Mexican Gulf, bringing it into the Midwest, storing it and distributing it, and getting out to the end users in that broader Midwest region. So the company and its shareholders saw a big potential in this, a relatively clean, relatively speaking anyways, energy form compared to oil, certainly coal, and therefore with a lot of also environmental positive aspects. To grow the business, they acquired a number of companies in the region, both in different types of distribution, but also different pipeline companies and companies that distributed the energy in the region. So they considered themselves, should we say, a midstream gas energy company. But they also, in addition to acquiring companies, they also engaged in different project investments in order to extend the network of pipelines and distribution channels in the region, and also extending to the outskirts of the region. It grew, and as you see in the stock price, the positive development was also transposed into a positive stock price development. As you looked at the growth prospects, the company leadership both looked at upstream activities, that is ensuring that you could actually get access to the gas, so there wouldn't be short of supplies, but they also looked at downstream activities, down the value chain to the end users. So they were also very cognizant of developing businesses or business activities that reached the final users. So the full value chain was taken into consideration, and they wouldn't just be dependent on specific parts of the value chain. The company actually also had some pretty innovative new initiatives, such as what they called simple choice, was actually a new way of trying to develop a service entity that went to the end users with different energy solutions, but also other types of homeowner solutions that customers might need, such as different telephone services, long distance and cellular, wireless internet service, cable TV, maintenance, security, and so forth, and packaging that together as a way of enhancing the service to the end users. And they even outsourced this type of service to other companies. So quite an interesting development, an initiative taken to expand their business. So when we look towards the end of 1998, which is the end of this price range that we have on the screen, we notice a very positive development. So in 1997, the last full year, there was actually a 41% return on investment for shareholders, almost as high the year before. So a very positive trend. The company was also growing, and it was actually the second largest natural gas pipeline operator in the United States at the end of 1998. And the positive trend was actually reflected in the fact that the company board approved a 7.1% increase in the quarterly dividend payments in November 1998. And also approved a 3-for-2 split of the shares. So the shareholders would, for every 2 shares, they would have 3 shares as a reflection of the positive development. So if we lean back and look at this, what would we conclude about this company? In other words, would you invest in these shares? I guess many of us would be inclined to do so. Because the story is very positive. Yes, if you look at the balance sheet, which I didn't show here, but you can see it in the case, they did invest more in the expansion, in different projects and so forth, and they did also incur more debt. But it was not like an excessive leverage at this point, at least from a cursory review of the situation. So many would probably be inclined to invest. That is a positive outlook. And even management obviously believed in their own situation. Now, what happened then as we go to the reporting for 1998, there was actually a 104% increase in operating revenues. And there was a 136% increase in operating income for the year when we closed at December 31st, 1998. That's great. The problem was that in the fourth quarter, the company actually reported a loss. So you'll see there is a little dip off at the end of the period. So they reported a loss of $3.7 million. Why is that? Well, it turned out, and I can go to the next slide and maybe show a certain negative trend. Well, the fact is, it was a very mild winter, an extraordinary mild winter, one you hadn't seen for many years. So for this reason, the demand for gas to as an energy source to produce heat, et cetera, was very low, and hence gas prices were reduced. So what was the risk factor? Was it the gas price? Well, yes, on the surface of it, but it was really a natural event that nobody had really thought about that caused the gas prices to drop. And the fact that KN Energy had actually invested heavily in assets that were dependent on the gas price meant that they had to write off these assets. As you see on the second slide, the gas prices, or the gas price trend, that's the red line, is quite volatile, but it's negative throughout the period. And what you notice is that the company stock is following a much more negative trend. And obviously that put pressure on the company. So as a consequence of this, I mean, management of KN Energy, Larry Hall, started negotiating with the largest local, or one of the largest local energy companies, Sempra Energy, headquartered in San Francisco. And they actually announced the merger in February, towards the end of February 1999. So everything should be fine in terms of finding a solution to the situation. However, as often happens, they couldn't agree, and the merger was reversed in June 19, it was never really completed, but the negotiations broke down and they announced that it wouldn't happen anyways. And that was back in June 1999. Shortly after, the official statement was that KN Energy would take over Kinder Morgan, a large energy company in the same type of business. But in reality, it was Kinder Morgan that took over KN Energy. And if you go today and look at or search for the name Kinder Morgan, you will find that it's a big energy company quoted on the New York Stock Exchange. So what is this telling us? Well, it's a nice little story that from real life that explains to us what happens when you overlook a major potential source for downside risk. In this case, yes, you could have talked about volatile gas prices, but incidentally, what really triggered it was extreme weather conditions that nobody had thought about. So that's an interesting story, isn't it? In other words, when you look at a corporation, there are different risks that can hit you. In this particular case, you could argue it was something related to financial market prices or commodity prices, the gas price. Obviously, the company was exposed to the gas market. But what triggered the gas price or the negative development in the gas price was actually an exogenous event like climate conditions. So there was an unusually mild winter that actually triggered this thing. So the fact is, yes, financial market prices that the case illustrates, but there are many other factors that might affect the business. And already alluded to those earlier. It could be things like economic policies, inflation rates, demand conditions, et cetera, et cetera. You go around the whole circle of things that might happen around the corporation that could affect the performance of the organization. And that is really what risk management is about, trying to understand this set of conditions around the organization that might affect the ability to manage the business properly and create an optimal return for owners of the organization, which is not so easy. So you would like to avoid, in this case, adverse events, but you might also try to gain some advantages if you can foresee things that are or could be used in a positive way in the organization. So understanding this context is a very important first step. Now, we talked about KN Energy. Can we think of other types of risk or incidents that have been instrumental or had or shows examples of negative outcomes? Well, you look at the risk, the list here, and you see that in trading, stories like Baring Brothers, which was one of the oldest merchant banks in the UK, actually vanished because a trader, Nick Leeson as it was, actually exceeded his limits and took positions that brought the company down. There's a whole movie made around this incident that you can study with interest to see how these things might happen. Metallgesellschaft, a big old German company, had a subsidiary in the US that took positions in the energy market. So they sold oil on long-term contracts because it was a high price outlook for oil, and they tried to hedge it by buying short-term futures contracts. Now, the short-term futures contracts, they had to close along the way because they were shorter term, and you had to close those positions, and it had cash flow implications that went on disregarding the long-term contracts. So eventually the company had to, because of cash flow pressures, had to unwind the positions and lost a lot of money. Societe Generale is a more recent story that resembles Baring Brothers, where an individual dealer actually took excessive positions. We can look into investment type of exposures. Orange County, the wealthy municipality south of Los Angeles, actually invested in instruments where the return on the investment was geared to different interest rate differentials between short and long-term interest rates. And when they went in their disfavor, they lost a lot of money that actually brought the municipality into receivership and so forth. Long-term capital is another example of an organization that took positions in differentials between different government bonds. So government bonds are not high-risk investments, but when you make small positions or positions in small interest rate differentials and you gear them up into large exposures, when the market turns against you in unexpected ways, you can lose a lot of money. And that's exactly what happened. Other examples relate to the reporting of your assets, where people actually have been cheating. So we're talking about fraud. The Maxwell companies is one example. Parmalat, the Italian food conglomerate, is an example. And Enron from the US is another example of companies that tried to or pretended that they had a lot of value where they actually did not. So we see here different types of exposures that relate to financial risks and economic risks, you might call them. We also think of other risks that relate more to supply chain situations. They could also relate to public relations situations, such as Arthur Andersen that advised Enron and was involved in the wrongdoing in Enron and therefore lost their reputation and ceased to exist. Other examples relate to innovation and technology, where, for example, Kodak ceased to exist because they couldn't, or they were unable to to exploit